this lecture, we're going to talk about the introduction to charts in Forex. First of all, what is a Forex chart? A Forex chart is the graphical representation of the relative price movement of a currency pair or pairs. Technical analysts and day traders look to such charts for signals and patterns to inform their trading decisions. Now, let's talk about the types of Forex charts. Firstly, we have the line chart. Secondly, we have a bar chart. And lastly, we have a candlestick chart. Now, we'll explain each of these Forex charts and let you know what you should know about each of them. Let's start with the line charts. A simple line chart draws a line from one closing price to the next closing price. When strung together with a line, we can see the general price movement of a currency pair over a period of time. It's simple to follow, but the line chart may not provide the trader with much detail about price behavior within the period. All you know is that price closed at X, and at the end of the period, you have no clue what else happened. But it does help the trader to see trends more easily and visually compare the closing price from one period to the next. Line chart is this type of chart is usually used to get a big picture view of price movements. The line chart also shows trends the best, which is simply the slope of the line. Some traders consider the closing level to be more important than the open, high, or low by paying attention to only the close. Price fluctuations within a trading session are ignored. This is an example of a line chart. You can see it's just basically a line. There are no candlesticks or anything like that on this chart. Next chart we're going to look at is called the bar chart. A bar chart is a little more complex. It shows the open and closing price as well as the highs and lows. The bar charts help a trader to see the price range of each period. Bar charts are also called OHLC charts because they indicate the open, the high, the low, and the close for that particular currency pair. So the full meaning of OHLC is open, high, low, and close. And as you can see here, this is what a bar looks like. This is the high, this is the close, this is the open, and this is the low. So price opens here for a period. It goes down, creates a low, goes up, creates a high, and then comes to close at this point. Here's an example of a bar chart for Euro USD. You can see how it looks on the screen here. Next chart we're going to look at is the candlestick chart. Now, the candlestick chart is a variation of the bar chart. Candlestick charts show the same price information as the bar chart, but in a prettier, more graphic format. Many traders like this chart because not only is it prettier, but it's easier to read. So this is what a candlestick looks like. Just like the bar chart, you have the open, you have the low, you have the high, and then you have the close. This is for a bullish candle. And for a bearish candle, you have the open, you have the high, you have the low, and you have the close. So you can notice that for a bullish candle, the open is usually below the close. And for a bearish candle, the open is usually above the close. You should take that into consideration when looking at candlestick charts. So here's an example of candlestick charts on Euro USD on the screen. You can see how different it looks from the other charts which I showed you guys prior to this. So we're going to talk about candlestick patterns now. So we'll talk about bullish candlestick patterns first. And firstly, we have the hammer. The hammer candlestick pattern is formed of a short body with a long lower wick and is found at the bottom of a downward trend. A hammer shows that although there were selling pressures during the day, ultimately a strong buying pressure drove the price back up. The color of the body can vary, but green hammers indicate a stronger bull market than red hammers. So this is what a hammer candlestick looks like. You can see the price was trending downwards, and then it has a body and then a long wick to the opposite direction. So this is what the hammer looks like, and it indicates a reversal or change in trend. And the potential direction is to the upside. So this is an inverse hammer. Inverse hammer is just the inverse of what a hammer is. It's a body with a long wick to the upside, still indicating a reversal and to the upside, because you can see price was coming from a downtrend, and then a hammer was formed, and then price starts to reverse into an uptrend. So a hammer is an example of a reversal pattern in the market, a reversal candlestick pattern. Next, we have the bullish engulfing pattern. A bullish engulfing pattern is formed of two candlesticks. The first candlestick is a short red body that is completely engulfed by a larger green candle. Though the second candle opens lower than the first, the bullish market pushes the price up, culminating in an obvious win for buyers. So this is what it looks like on the charts. So you can see that price was coming down in a downtrend, and we now have the last down candle was engulfed by the next bullish candle. You can see that this entire candle was engulfed by the next bullish candle, which shows a bullish engulfing pattern and is a potential for reversal in the market from a downtrend to an uptrend. Next, we have the morning star. The morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It's a tree stick pattern, one short-bodied candle between a long red and a long green. Traditionally, the star will have no overlap with the longer bodies as the market gaps both on open and close. It signals that the selling pressure of the first candle is subsiding and a bull market is on the horizon. So this is basically what a morning star pattern looks like. So you can see the price was in a downtrend, and then there is this bearish candlestick, massive bearish candlestick with a smaller bearish candlestick showing a depletion in selling pressure, and then a massive bullish candlestick in the opposite direction showing a reversal in the market, or a potential for reversal in the market, because the bulls have come into the market at this point in time. So this is what it's a three candlestick pattern here, and this is what it looks like. Next, we have the three white soldiers. It's also a candlestick pattern which occurs over three days or three candles. It consists of consecutive long green candles with small wicks which open and close progressively higher than the previous candle. It's a very strong bullish signal that occurs after a downtrend and shows a steady advance of buying pressure. So this is what the three white soldiers look like. So we can see that we were going down in a downtrend, and suddenly we start to see three consecutive bullish candlesticks in the upside. This signifies a potential for reversal to an uptrend. So whenever you see a downtrend followed by three increasing bodied candlesticks, bullish candlesticks, it indicates a three white soldiers pattern, and it's a potential for a reversal in the market. So we're going to talk about bearish candlestick patterns now, and the first one we have on our list is hanging man. The hanging man is a bearish equivalent of a hammer. It has the same shape but forms at the end of an uptrend. So remember when we talked about the hammer, the hanging man is basically just the opposite of a hammer, because the hammer is a reversal pattern from a bearish market condition to a bullish market condition, or from a bearish trend to a bullish trend, or you can say from a downtrend to an uptrend. It indicates that there was a significant sell-off during the day, but that buyers were able to push the price up again. The large sell-off is often seen as an indication that the bulls are losing control of the market. So this is what a hanging man pattern looks like in the market. You can remember what we talked about when we talked about the hammer. The hammer was indicating price moving from a downtrend to an uptrend. But in this case, you can call this a hammer as well, but it's indicating a reversal from an uptrend to a downtrend. Next, we have the shooting star. Now, the shooting star is the same shape as the inverted hammer, but is formed in an uptrend. It has a smaller lower body and an upper longer wick, or a long upper wick. Usually, the market will gap slightly higher on open and rally into an intraday high before closing at a price just above the open, like a star falling to the ground. So let me explain. So it's just like the hammer as well, but it's signifying a potential for an uptrend to reverse into a downtrend. You understand? So it shows that price opened at a certain level in the market, and then price pushed higher, creating a wick, and then closed below, creating this bearish body with a very long wick in the opposite direction. So it shows potential for a reversal from an uptrend to a downtrend as well. Next, we have bearish engulfing. So the bearish engulfing is just the opposite of a bullish engulfing, and it's a pattern which occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a subsequent long red candle, just the opposite of a bullish engulfing. It signifies a peak or slowdown of price movement and is a sign of an impending market downturn. The lower the second candle goes, the more significant the trend is likely to be. So let me show you what it looks like on the chart. So now, bearish engulfing pattern, you can see that we were in an uptrend, and this was the last bullish candlestick, which was engulfed by a bearish candlestick. This pattern here signifies a potential reversal in the market from an uptrend to a downtrend. Next, we have the evening star. The evening star is a 3 candlestick pattern that is the equivalent of a bullish morning star. It is formed of a short candle sandwiched between a long green candle and a large red candle. It indicates the reversal of an uptrend, and it's particularly strong when the third candlestick erases the gains of the first candle. Now let me explain what that means on the chart. So you can see that we are going up in an uptrend, and then you have this 3 candlestick pattern here. A large up candle, a smaller up candle showing depletion in momentum, followed by a large red candle to the opposite direction. So you can see this 3 candlestick formation. It signifies a reversal or potential reversal in the market. Next, we have the 3 black crows. The 3 black crows candlestick pattern comprises of 3 consecutive long red candles with short or non-existent wicks. Each candle opens at a similar price to the previous one, but selling pressures push the price lower and lower with each close. Traders interpret this pattern as the start of a bearish downtrend, as the sellers have overtaken the buyers during 3 successive trading candles. So this is what the 3 black crows looks like after an uptrend, and you see 3 consecutive bearish candles with very little wicks or no wicks at all. This is the 3 black crows pattern. It signifies a potential reversal in the market. Next, we have a doji. So when the markets open and close are almost at the same price points, the candlestick resembles a cross or plus sign, and traders should look out for a short to non-existent body with wicks of varying lengths. So the dojis usually have very little or non-existent bodies. It's a thing to note when looking out for these candlestick patterns. The doji's pattern conveys a struggle between the buyers and the sellers that results in no net gain for either side. Alone, a doji is a neutral signal, but it can be found in reversal patterns such as the bullish morning star and bearish evening star. So this is basically what a doji looks like. You can see very little body, very little body. You can see here very little body. It can have large wicks or non-existent wicks, but it has very little body, and it signifies indecision in the market. Now let's talk about time frames in Forex. Forex time frames are commonly classified as long-term, medium-term, and short-term. Traders have the option of incorporating all 3 or simply using one longer and one shorter time frame when analyzing potential trades. While the longer time frames are beneficial for identifying a trade setups, the shorter time frames are useful for timing your entries. Each time frame denotes the duration of each individual candlestick. Examples of time frames in Forex. Firstly, we have short term, which is 1 minute to 1 hour. This time frame is usually suited for scalpers and short-term traders. Secondly, we have medium term, which is 1 hour to 4 hours. This time frame is usually mostly for intraday traders, more suitable for intraday traders. And lastly, we have long term, 4 hours to daily, weekly, or monthly time frame. This time frame is suited mostly for swing and position traders. You guys remember what we talked about when we discussed terminologies and types of traders rather. We talked about scalpers or short-term traders, intraday traders, and swing or position traders. So let's head over to the charts for a better explanation of the time frames. Okay, so we'll talk about time frames in this using this chart of Euro USD. So you can see here on TradingView, you have different time frames in the market. So you have the 1 hour time frame, the 30 minutes time frame, the 15 minutes time frame, 5 minutes, 1 minute time frame. So time frames just denote the time it takes for a candlestick to form in the market. So in this situation, we're on the 1 hour time frame. So each of these candlesticks are developed within a period of 1 hour or 60 minutes. You understand? If I switch over to the 15 minutes time frame, you can see that each candlestick on this time frame was created within a period of 15 minutes. And if I switch to the 5 minutes time frame as well, each candlestick within that time frame was created within a period of 5 minutes. So we can see here that each candlestick here was created within 5 minutes. So with that being said, we've come to the end of this lecture, and I hope to see you in the next one.